Hello and welcome your tune into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we are going to put focus on investing via the systematic withdrawal plan. It's exactly not investing, it's taking money off your investments. But what are the benefits of going ahead in this mode? Which one is better? There is SIPs, there's SWPs, but of course we compare SWPs with dividend funds. So there's a lot that we need to discuss, but because there have been recent updates about how people have been making a lot of money and investment returns have been higher via SWPs. So we are going to discuss this and more with Udayan Adhye, the founder at Udayan on Money, and Rushabh Desai, founder at Rupee with Rushabh. Gentlemen, good afternoon. Thank you so much for joining in. Always a pleasure to speak with the two of you. And you know, as I said recently, there have been a lot of comments about how SWP is the way to compounding of your returns. So we need to understand whether that's the right thing or not. But before we do that, let's talk about the basics. Rushabh, let me start with you. What exactly is an SWP and how does it differ from an SIP?
Hi, Sonal. First of all, thanks so much for having me on the show. It's always a pleasure to talk to you. See, SWP, in very simple words, it means systematic withdrawal plan, right? It's an automatic method to withdraw a certain amount of money on a fixed date. Now, investors can withdraw weekly, monthly, quarterly, semi-annually, annually, and so forth, right? On the other hand, SIP is systematic investment plan, right? You're actually investing money in mutual funds in an automatic method on a fixed particular date. Now, again, this can be on a weekly, monthly, quarterly, semi-annually, and annual basis. So SWP means withdrawing money on a fixed date on a certain amount, and SIP means investing money in mutual funds on a fixed day on a certain amount.
Okay, so because we keep talking about SIPs, so I thought it's time to talk about what the withdrawal plan also would look like. Udayan, let me come to you. Now that we have spoken about the basics, SIPs versus SWPs, can you explain with an example, how would an SWP impact investment returns, say, over 5, 10, 20-year period for any investor?
Thank you so much, first up, Sonal, for having me, and good afternoon, Rushabh, to you as well and all the viewers. So, SWP is something that has been more and more discussed in the past few months or the past year. And I honestly believe that SWPs are simply meant specifically for people who want to generate an income from their investments. And that sounds like a very fancy phrase, right? Who doesn't want to generate income from their investments? But the moment you start an SWP, for all intents and purposes, it is a withdrawal that you're making. It is a redemption that you're making. The only difference between normal redemption and an SWP is that in an SWP, you're scheduling that withdrawal. So, you know, for example, it's a monthly SWP, then you're telling the mutual fund house that every month on this date, I want X amount of rupees. Now, if you notice, when you're taking money out of your investment, it is definitely going to affect the compounding that could take place, right? Because think about it, you have 1 lakh invested and you're taking out 5,000 rupees from it every single month. So for the first month, you have 1 lakh rupees invested, but for the second month, now you have 95,000 rupees invested. For the second month, you have 90,000 rupees invested. And if at that time, the market goes up, it's not going to go up on the 1 lakh rupees that you had invested. It's going to go up on the 90,000 that you have invested. So it affects the process of compounding. So as far as possible, SWPs should not be started by someone who is still in the accumulation phase of their life, where they're still working, where they're still saving for various goals. It should ideally be started by retirees. And just to give you an idea as to how it affects investment returns, so a 10,000 per month SIP, let's say you had continued that for 15 years at a 10% step up, and it grows at 12% annually. That would grow to about 85,000 rupees. But if you have an SWP that is started from the very first month of 3,000 rupees per month, and you're increasing again by 10% every year to keep up with inflation, then in that instance, you have about 60 to 65 lakh rupees. And this effect only becomes even more stark with a longer time frame. Because remember, you're taking money out in an SWP, which affects compounding.
Okay, so not the best idea if you want to return better money or higher money for yourself. Thank you for the explanation, Udayan. Rushabh, you agree with it? It is not the right thing to go about. SWP, that is, systematic withdrawal plan. With an example, if you can explain.
I agree what Udayan had to say, actually. I would like to add one point that, before starting an SWP, it's very important that the money is invested for a couple of years, right? You don't want your capital to be affected over a longer period of time, right? So, we usually tell our clients that before starting an SWP, you invest the money in the market and let it grow anywhere between 1 to 3 years. This allows your capital to grow and come in the profits, right? Once you are in profits and then you start the SWP process, your capital is safe. The systematic withdrawal amounts are also not affected, and you will also make some money over and above your capital, right? So again, see, just to give you a very small example, say if someone wants to draw 50,000 rupees per month, they will need an investment corpus of 50 lakh of rupees, right? Assuming 12% CAGR returns for a period of 10 years. This is, I'm assuming, if the investor wants an SWP for a period of 10 years. Again, the investor needs to get the assumed returns also right? See, for example, we tell our clients over a longer period of time, we expect 12% CAGR returns in equities. We tell our clients, don't pull out exact 12%, probably, pull out 2 to 4% less than the assumed returns. So this allows the investor capital to be protected, withdrawal amount to be secured, and the investor will make some kind of returns over and above of the withdrawals he or she is making, Sonal.
Okay, so at the end of the day, the balanced corpus is equivalent to the corpus that you had earlier, the capital that you had earlier, of course. So it protects your capital, but as both of you have mentioned, it would not be the best advice to do in case you are looking for higher returns as well. Udayan, let me come to you. When would an investor go for a systematic withdrawal plan?
The classic example or the classic instance where you want to set up an SWP is during retirement. So let's say through all the various retirement benefits, through your investments that you have made while you were working, you've accumulated a certain amount of money. Now, obviously, for most people who are working today, they would not get a pension. Now, in that very specific instance, what we want to ensure is that the money that you have saved up for all this time, that is going to last you for the next 30, 35 years of your life, right? Because income has stopped. So in this specific instance, I think then an SWP would be perfect. And the global average for what the safe withdrawal rate is, how much money you need to have to be able to live off that money for the rest of your life. The global number is 25 times your annual income. In India, though, that is very different. It is not 25 times. It is about 30 to 35 times your annual income that you want. So let's say you want to withdraw 1 lakh rupees. That is about 12 lakh rupees per year. And you want that money to last about 30 to 35 years. In that instance, you need about 30x of that. So that about 3.6 to 4.2 crores. And this was a fascinating study that was conducted by two brilliant Indians, Ravi Sarauji and Rajan Raju. Wonderful study, the first of its kind in India. So while people want to withdraw 6, 7, 10% of the money, you're going to run out of money in that case, right? Because with every year, you would pull out more and more money because of inflation. So remember that number, right? Between 30 and 35 times of your annual target income is what you'd ideally want to have saved up, because you can only withdraw 3 to 3.5% in a very safe way.
So you need a lot of money to even withdraw money. That's exactly the crux of SWP here. Rushabh, let me come to you. First, when do you think one should go about it? And second, what are the benefits, if any, for any investor if they have to go ahead with systematic withdrawal plan?
Sonal, first of all, I'll come to the benefits actually. See, I mean, SWP is a phenomenal methodology. Someone who wants hassle-free, quick, automatic liquidity on a regular basis, right? As mentioned earlier, there are three things what investors need to keep in mind is that to get the approximate long-term returns of an asset class, right, pull out 2 to 4% less than the assumed returns. In this case, the withdrawal will be unaffected, capital will be unaffected, and your capital will also grow. Now, if you see, SWP works best in growth options, especially for equity products for the products who fall under the equity taxation. Because in IDCW, which is income distribution come capital withdrawal and dividend options, you are not only charged TDS, but your the money, the gains go as is taxed as per your tax slab. So in terms of equity, it's 20% for short term and 12.5% for long term. So I think SWP will work best in equity related products because there is a lot of tax efficiency as well. As Udayan also rightly said, I mean, I wouldn't encourage someone to go for SWP in the accumulation phase when they are young, probably in their 20s, 30s, and 40s. I think ideally people who have accumulated over or grown their corpus over the period of 10, 15, 20 years, and after that starting an SWP either from equity or probably shifting the equity if they cannot stomach too much of volatility probably towards the later years. I think shifting from equity to either hybrid products or debt products and then doing an SWP would work best. But keep in mind that, of course, inflation is going to eat up, your pockets and your returns. So I think in the accumulation phase, a lot of saving and most importantly, investing in equity as an asset class needs to be done thoroughly. I mean, I encourage my clients to save at least 50% and invest that 50% of your monthly income into equity during your accumulation phase.
That makes sense. As we were pointing out earlier, you need to accumulate some corpus before starting a systematic withdrawal plan. And as Udayan mentioned, you need to have money to withdraw money at the end of the day, right? So, gentlemen, there's so much more to understand about this phenomenon, but we have to take a quick break. On the other side, we'll continue our discussion with Udayan Adhye and Rushabh Desai to understand everything about systematic withdrawal plan. Welcome back. You're still tuned into MF Corner. We still have with us Udayan Adhye and Rushabh Desai, and we are understanding everything about systematic withdrawal plans, whether they are a good option and whether you should go about it or not. Gentlemen, we have discussed the basics, what it exactly is, what could the final returns look like. Udayan, let me come to you now. Suppose somebody has decided, yes, they need a monthly income, they need to withdraw some money. What is better for them, dividend funds or systematic withdrawal plan?
So, with dividend funds or income distribution come capital withdrawal, that's the technical name, the challenge is that the money that you get is taxed at your income tax level. So that if that is in the higher tax brackets, then in that case, an SWP could be a better idea, simply because the SWP money that hits your account for balance funds, for all equity funds, that is taxed as capital gains. So for long-term gains, that would be about 12.5%, and every year you get 1.25 lakhs tax-free within that sphere. So in that case, if you're in the higher tax bracket, anything above 15%, then SWPs could be a good idea. But for, let's say, someone who's not at all in the taxable income, then straight up your withdrawals or the dividend that you get from mutual funds, that could be an option that you may pick. But remember once again, right, that the money that you would withdraw as a retiree every single year would keep going up because of inflation. And because of that, you don't want to, just set that and forget it, because you could very well in 5 years, the money that you're withdrawing, that could now be higher than your taxable limit. So now your income could be taxable at a higher rate. So SWPs for anyone above the 15% bracket, I think, makes the most amount of sense than the dividend option.
Okay, all right. So on the higher income side, it makes more sense to go for an SWP. Rushabh, let me come to you because, of course, we cannot time anything. With SIPs, we always say that you cannot time your SIPs or the markets. But when is the best time to do an SWP or systematic withdrawal plan? Is it monthly, is it yearly, or is there a specific time period that you should be looking at?
Sonal, I think the best methodology is either to do it monthly, semi-annually or annually. I wouldn't recommend clients to pull out money on a very, very regular basis. I think most of the cases, because we require some kind of money during the starting of the month for our expenses, throughout the month. So I think doing an SWP either on the first or probably last week of the month would be best. It's typically meant for those who require cash flow. See, I'm saying this very specifically, Sonal. I mean, whether you are at the retirement age or somewhere in the middle age or 30s or 40s, it is purely for someone who requires some kind of cash flow, to meet their expenses or whatsoever reason, right? Stay invested for at least 1 to 3 years before pulling out your money, because this allows your product to go into profits and make sure that the capital is not hit. So I think SWP works best on a monthly basis, but make sure to step up, not very regularly, not on a yearly basis, but at least try to step up on a 2 to 3 year basis, so that your withdrawals are also protected, your capital is also protected, and some amount of money also grows.
Okay. Udayan, your take, is systematic withdrawal plan something that should be considered as a style of investing?
If you're not retired, right? If you're still in your accumulation phase, you're earning money, take it up as literally the last resort, because you're working hard, you're investing money, and that money is compounding. The markets have done well in the past 5 years, so you'd have seen good returns. So there's always the temptation, okay, can I take some money out to on a regular basis? When that happens, you are again affecting the process of compounding. I am personally a bigger proponent of, if you need money, then set up a redemption. Don't set up a systematic redemption. So it's not a redemption that hits your account every single month, unless of course you're in a position where, let's say, you have been laid off from your job or you can't work and now you need to generate some kind of income from your investments. At that time, go ahead. But for meeting specific goals, like, right, let's say you want to go for a vacation, you want to buy a car, you want to fund the down payment of your house, in that case, just set up a straight up redemption for that amount. And that is working with someone who understands your finances, whether it's a mutual fund distributor, whether it's a registered advisor. They can help you out with this process more, because as you get closer to a goal, you want to move some of that money into a safer asset. But SWPs typically for people who just want to generate income. But remember, it's going to affect the compounding process, and you're going to end up with lower returns over a period of time, because at the end of the day, you're taking out money that could have grown in the future.
Makes sense. And as you rightly explained, it will impact the compounding that you see if the money stays in your account. So redemption is better than with systematic withdrawal, so to say. And as Rushabh also said, it really depends on the situation, the profile, and what you want to do with that money at that point in time as well. So Rushabh, you mentioned that, maybe the first of any month, the last day of any month, and also depending on what kind of money you want and the inflation. So should one increase their SWP basis the market condition? How can one go about it and change the amount? Or do you think it can remain stable over years?
I mean, if you let the money grow for some years and then start to pull out, I think it will remain the way it is. I don't see much of step up needed in that way. But of course, see, inflation. See, today the headline inflation is quite lower. I don't deny the fact. But again, investors should keep in mind that, my expenses and my lifestyle will be very different from your expenses and your lifestyle. So my inflation figure and your inflation figure will be, of course, very different. See, retail, for a retail or probably a middle class or a lower middle class, the inflation would be, say, 4 or 5%. But for an HNI or an ultra HNI, the inflation can go as high as anywhere between 10-15%, right? So it first of all, you really need to accumulate money. We are not a very pension friendly country. I mean, in corporate sector, we don't get any pension after our retirement, and even in the government companies and whoever are government employees, they also don't get that substantial amount of pension. Looking at our lifestyle, that we want to explore a lot of things in life today. So I think, venturing towards a little bit of a simpler lifestyle, people who have limited resources, budgeting well, and Udayan also has correctly said that rather than going for an systematic withdrawal plan, I think probably punching in redemptions from time to time, say probably during a bull market, that would work best. Probably if you have decent amount of income, other sources of income during a correction period or a bear period, I wouldn't suggest, to pull out money or to reduce units during the bear period. On the other hand, if you have some kind of money in hand, cash in hand, pump in more money during bear market. That will help you accumulate more units. That will help you, your money grow over a longer period of time during the bull run. So number one, I think systematic withdrawal plan should be done, has to be kept as a last resort for people who are young, who are in their 30s, 40s, and make sure that don't go overboard in pulling out money. You can step up on a 3 to 4 year basis, or probably 2 to 3 year basis, but try to step up anywhere between 5 to 7%, probably not more than that.
Okay, all right. So both of you have made it clear that it's better to see redemptions than do a systematic withdrawal plan, because that would not tinker with the compounding that you're seeing, and also you can phase it out or you can pace it over different market cycles as well. So that is clear, but still taking it ahead for the benefit of our viewers, then is it good, say, for a particular category or a mutual fund, or this is across the industry, that you should not go for systematic withdrawal plan for any of the categories, so to say, be it debt or equity?
So typically you can set up an SWP. You're allowed to set it up across any category, whether it's an equity fund, an index fund, a balanced fund, a debt fund. But what do you really want to do, right, when you're getting hands-on with your money? Because remember, in an SWP, I again keep saying you're withdrawing money from your investments. Now, if it's in an all-equity portfolio, which is a volatile asset at the end of the day, in the past 40 out of the past 44 years, the Indian stock market has dropped 10% in every calendar year. So keeping that in mind, if you start an SWP from an all-equity portfolio, it's going to be much riskier, because there is a chance that the markets are down 10%, 20%, even 30%. We have seen those times, right? And at that stage, if they linger at that lower level for a while, then you're pulling out money at a lower unit rate, or when the markets are low. So again, you're going to erode your capital very fast. So in that case, when we are working with our clients, what we usually recommend is you opt for an SWP from a very diversified balanced portfolio. So that has equity, that has bonds, that has gold. This can be done through balanced funds. This can be done through multi-asset funds. But it's very important, even then, to have equity in your portfolio, because as Rushabh was also saying, that the inflation that we see reported on the TV, in the newspapers by the government, that is inflation for the lower middle class or middle class population of India. For a lot of people, that would be around 8, 10, 15%. So just to give you an idea, if the inflation is 8%, what you can buy with 1 lakh rupees today per month, you'd require about 2.25 lakhs in 10 years, about 4.5 lakhs in 20 years, and 10 lakhs per month in 30 years.
Got it.
So you want that return to be above the inflation rate, and that's why you need that injection of equity, but keep it around 40, 50% higher if you're a very experienced investor.
Got that point, gentlemen. It was such a pleasure to have both of you on the show and talk about systematic withdrawal plan. There have been a lot of policies, or I would say a lot of myths floating around as well. So it's good to get clarification from experts as to how to go about this particular phenomenon. With that, we'll take your leave on MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.